Ladies and gentlemen, good day and welcome to the Arvind Smartspaces Ltd Q1 FY2024 post-results earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Amit Sharma from Adfactors. Thank you, and over to you, sir.
Thank you, Zico. Good afternoon, everyone, and thank you for joining us on the Q1 FY24 results conference call of Arvind Smartspaces Ltd. We have with us today on the call Mr. Kamal Singhal, Managing Director and CEO, Mr. Ankit Jain, Chief Financial Officer, Mr. Avinash Suresh, Chief Operating Officer, Mr. Prakash Makwana, Company Secretary, and Mr. Vikram Rajput, Head Investor Relations. Please note that a copy of the disclosure is available on the investor section of the website of Arvind Smartspaces Ltd, as well as on the stock exchanges. Please do note that anything said on this call which reflects the outlook towards the future, which could be constituted as a forward-looking statement, must be reviewed in conjunction with the risks and that the company faces. I would like to now hand over the call to Mr. Kamal Singhal for his opening remarks. Over to you, sir. Thank you.
Thank you. Good afternoon, and a very warm welcome to everyone present on this call. Thank you for joining us today to discuss the operating and financial performance of Arvind Smartspaces for the first quarter ended 30th June 23. I would like to begin by sharing my thoughts on real estate environment and broad highlights of the quarter. We can then look forward to taking your questions and suggestions. The Indian economy continues to move forward strongly, driven by a confluence of a large number of varied positive attributes, and is widely expected to emerge as the third largest globally by the turn of the current decade. Factors such as formalization, urbanization, employment generation, and mass affluence will certainly underlie the transitions likely to be seen in the country. These very trends also support the accelerated growth in the country's real estate sector, as the need for both functional, comfortable as well as aspirational homes, which continue to drive the long-term demand. As we all know, the real estate sector has already been experiencing a period of momentous growth. Most recently, the central bank's pause on interest rates has further improved borrowing conditions. Furthermore, historically low inventory levels have fueled a sense of urgency amongst the home buyers, leading to heightened demand, and this has further supported firmness in the property prices. With a trend of improved household savings and higher disposable incomes, individuals now have greater financial flexibility and confidence to invest in properties. These combined elements continue to strengthen an already robust growth outlook for the real estate market, offering a promising landscape for both investors and homeowners. Prominent experts in the Indian property market are projecting a very strong year ahead, and forecasts indicating a collective surge in sales of around 10 to 15% across the segments. In a market that is consolidating towards organized corporate developers, Arvind Smartspaces Ltd represent a new age real estate company synonymous with brand, design, governance, trust, legacy, and a very strong track record. We have distinguished ourselves not just by scale but by scope, not just by size but by style, and we are engaged in development of distinctive customer-centric properties which are spacious and aesthetic, that are designed to enhance the quality of life of our consumers. We enjoy strong scalability in horizontal and vertical developments both across its targeted geographies of Ahmedabad, Bangalore, and Pune. We have achieved a critical mass in operations marked by a very healthy profitability and operating cash flows. The company is net debt-free amongst very few Indian listed real estate companies to enjoy such distinction. These distinctive capabilities are the result of an overarching commitment to our philosophy designed to inspire. Our transformative philosophy makes us confident of capitalizing on the sector's opportunity in a meaningful way while maintaining financial discipline. Coming to our Q1 operational performance, we delivered 14% year-on-year growth in sales booking at rupees 135 crores, which was largely driven by sustained sales in ongoing projects. While sales are expected to accelerate through the rest of the year on the bank of further impetus coming from new launches and project additions, we are pleased to share that we recorded our highest ever quarterly collections from customers for the third straight quarter. Q1 collection increased by 54% to 204 crores, which took us beyond the 200 crores milestone for the first time in our corporate history. This, we believe, is an important achievement from our organizational perspective, given that it allows us to accelerate virtuous operating cycle of sales, construction and delivery to create a positive ecosystem for our brand amongst real estate consumers. More recently, we have added 2 new horizontal multi-asset township projects in South Ahmedabad, which span around 704 acres with a top-line potential of about 2,300 crores. Both the projects are signed under the JD model, enabling low capital intensity and higher returns. NH7, South Ahmedabad, is spread across 500 acres with a revenue potential of around 1,450 crores. And our economic interest in this project is 50% of revenue share. Bawla, the other one, also in South Ahmedabad, is spread across 204 acres with a revenue potential of around 850 crores, and our economic interest in this project is 55%. We have also signed a development management agreement to develop a 16 acres township at Moti Point near Ahmedabad with a potential of 116 crores. In Ahmedabad alone, we are now actively developing approximately 50 million square feet through our ongoing and planned portfolio. With the addition of these new projects, we are poised to expand our presence even further and solidify our position as a leading real estate development company in Ahmedabad. Now, moving on from operational updates to the financial highlights, Q1 24 we reported a revenue of 67 crores, up 11% YOY. Adjusted EBITDA for the quarter was higher by 19% to 16 crores and PAT grew by 11% to 8 crores. Our balance sheet position remains strong despite expanding operations, supported by strong generation of operating cash flows amounting to 111 crores for Q1 alone. We closed the quarter with a net cash position of rupees 87 crores. Our Q1 operating cash flows were more than half of the last year's full cash flows, allowing greater operating flexibility and creating potential for driving further growth on a robust balance sheet. This strong position has been reached despite sustained outflow of business development activities. Further, we estimate an unrealized operating cash flow exceeding rupees 2,100 crores from completed, ongoing and yet to be launched projects. To close, I would like to reiterate that while industry demand and supply remains healthy, consolidation and corporatization continue to improve prospects for branded players. A strong brand, expanding geographical presence, innovative product mix, prudent capital allocation, and pursuit of operational excellence should allow Arvind Smartspaces to continue its trajectory of profitable growth. We look forward to drive scale with more new launches and project additions across Ahmedabad, Bangalore, Pune, and MMR. On that note, I conclude my opening remarks, and I would now like to ask the moderator to open the line for question and answers.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Bajrang Bafna from Sunidhi Securities. Please go ahead, sir.
Congratulations for the entire Arvind Smart team for executing this large 700 crores project of 2,300 crores. That is what we have guided, that the business of close to 5,000 crores we are embarking upon, and I think it's a great achievement on that count. So my couple of questions. My first question pertains to the initial this 2,300 crore. I think we have already included that number in our cash flow estimation. Close to 500 crores has got added. So just to get a sense that, to my mind, it is not on the HDFC platform, and what is the initial investment till the launch stage, that will be required to bring these projects on ground, and when can we expect, the launch of these two large projects? And the second question pertains to specifically in the Bangalore project, Sarjapur and all, the launch which we were expecting in Q1 has got little delayed. So if you could, explain us when can we expect that now, and what are the timelines, for that launch? And because of that, little pre-sales numbers are close to 135 crores, little short of our expectations. So what is now the guidance for the FY24 in terms of achieving the pre-sales numbers? The growth that we guided initially of 20-25%, is it still on or not? So that is the second question. And third is the project pipeline. We have already done this 2,300 crores. So what sort of further project pipeline that you are envisaging for this FY24 or maybe FY25 will be really helpful, sir. That's all from my side, and thank you, sir.
So may we request you to unmute your line from your side, please?
Thanks a lot, Bajrang, for this. I'll take your questions one by one. And you're right that these two large projects, new projects in Ahmedabad, are not under HDFC platform. And whatever nominal investments are required in these projects will be done directly by us, and HDFC platform will not be a partner in this. So that's one. Because both these projects are joint development projects. And the second part of the question regarding how much we need to invest in these projects, the simple answer is that because these are joint development projects, hence the initial investment is going to be very, very nominal. And obviously that means these are going to be very, very asset-light projects, very similar to what we've been doing in uplands or high growth, etc. The next question you had was about the launch timeline of these projects. While these are very large projects, we have already started very, very aggressively designing and planning these projects. These are large master plans, and multiple products like plotting, like bungalows, like recreational facilities, etc., are being planned on these, and hence, but I can assure you that these are coming sooner than later. And the first one, which is the smaller of the two, around 200 acres, should be launched, at least phase one of that project should be launched in next 2 to 3 months' time. That's the target internal, and we are hopeful that should be achieved. The other one possibly can take few more months, because we are getting into some international architects and designing project, keeping a very long-term plan in mind. But we are still trying to see if we can launch this within this financial, more like in the Q4 of this year. So that's the launch timeline for these two projects. On the numbers, 135 crores has been achieved in this quarter. But you might have noticed that broadly this is sustained sale. In fact, sustained sales has come out to be a little better than what our internal predictions have been. But yes, we have not launched any new project for this quarter. But as we build, some of our launches are a little back-ended for the year. But we are very hopeful, and we are working towards the objective of achieving our stated objective of achieving growth at the rate of 25 to 30% over previous years in most of our parameters, and we are very hopeful that this should be achieved, and we are working on it. So target remains the same, no change there as such. A little low on the Q1 numbers, yes, but that's broadly sustenance. but back-ended launches are planned, and they are moving as per our expectation, and they should hit the market as we plan from here onwards. So broadly, we are still keeping the same target, and we should be able to achieve it. Further, your last question, I guess, pertains to the overall investment and project pipeline. If you recollect, in the last call, we said that the idea is to invest around 1,000 crores in total this financial year. We are moving very fast on this. Currently, as we speak, we've just announced these 2 projects, but the pipeline is strong. Quite a few things are happening, and we are at a fairly advanced stages of a few of those projects. And we are quite hopeful that this target of spending 1,000 crores should happen within this financial year. So that's also looking like broadly on track.
Okay. Thank you, sir.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Ritvik Sheth from One Up Financial. Please go ahead, sir.
Yeah. Hi. Good morning, sir. Sir, I have a couple of questions only. Firstly, you have mentioned, the upcoming projects which are in pipeline from slide 16 to slide 22.
Can you speak a bit louder? Can you speak a little louder? Can't hear you properly.
Is this better?
A little better now, yes.
Yeah. Sir, you have given upcoming projects from slide 16 to slide 23. My question is that, there are quite a lot of projects, 6-7 projects which are in pipeline, 2 of them which we have acquired recently. So what kind of launches we can see for the rest of the year from FY24? You just mentioned that it's planned to be back-ended. So can we expect, 3-4 projects to be launched from this 7-8 projects in pipeline in FY24?
You're right. Quite a few projects are listed in the presentation. And if you really see project to project here in this presentation, I can tell you few of them that are in any case planned to be launched. Sarjapur Villa project is almost ready to launch because of changes in the administration, etc. Last few things are happening, and it should be launched any time from now. So that's one. Then we are also targeting to launch Dodlapur in next few, maybe a couple of months or thereabouts. Okay. That is also slated to be launched there. Greatland remaining phase has to be launched. This will also come within a couple of months or 3 months time from now. North Bangalore is another project which we are targeting to launch. So that's upcoming, and it should be launched within this financial year in any case. Apart from that, the 2 new projects which we just announced, one of them should be launched in next 2 to 3 months time. The other one is targeted to be launched more towards the end of the year, and we are pushing to ensure that somehow it is launched in Q4 of this year. But nevertheless, the first one, 200 acres Bawla one, should be launched in next 2 to 3 months time from now.
Okay.
So broadly, most of the projects that you see as upcoming are coming under launch in next few months of this financial year.
Right. And just one follow-up from previous participants' question on the investments. You mentioned that we're looking to invest 1,000 crores in FY24. So obviously this includes the HDFC as well, right? HDFC investment.
Correct.
Cumulative
yes.
with them.
Yes.
You wanted to clarify that. Okay, sure.
Yes.
And sir, last question from my end. We are looking to foray into MMR mainly in Pune. Pune we have a project, and in outskirts of Mumbai as well. So any progress on that front?
There is nothing much that can be shared at this point in time, although the activity level and the engagement levels with the market for the pipeline and for the project acquisition, etc., is very, very hectic here. Not in a position to really specifically talk about something because they are not finalized yet. But yeah, the team is out there in the field. We are evaluating quite a few projects, both in Pune and MMR. and hopefully within this year we should be able to start a couple of such initiatives in these two cities.
Okay. And just one last question. So this investment of 1,000 crores, bulk of that would be in Ahmedabad and Bangalore, and some of that would be in Mumbai, Pune, MMR Pune. Would that be a reasonable understanding?
So if I were to recollect our earlier discussion, maybe in the previous one or the previous call, we have kind of planned to invest 40% each in Ahmedabad and Bangalore in the medium term, and around 20% in MMR and Pune. Pune and MMR is a bit low because we want to make sure that we are firm-footed in these two markets, and we build cumulatively on our experiences there, treating these markets as local ones, and hence the proportion. So in the medium term, just to reiterate, 40-40-20 should be our broad plan in these three cities.
Okay. Got it, sir. Thank you and all the best.
Thank you.
Thank you. Our next question is from the line of Biplab from Antique Stock. Please go ahead.
Good afternoon, sir. Hope all is well. Sir, my first question is, can you give us some insight on life cycle of a plotted or a bungalow project in terms of timeline and cash flow? Basically trying to understand, sir, how horizontal projects are different from, say, mass housing vertical project in terms of cash flow and timeline. So this is my first question.
So you're talking about a typical plotting project in Bangalore, right? If, for example, Great Lands could be one of the benchmarks there. That's what you're asking generally?
In general, sir, just trying to understand how the cash flow comes, how the cost goes, how long it takes for the project to be delivered, and how quickly the cash flow. Just trying to understand that part. Sure. Timeline as well as cash flow. Typical project, any project, sir, that you think is a typical project.
Sure. So typically a large plotting project will have phases because you aggregate lands in phases only. Unless you have something like 100-acre aggregated in one shot before you launch, which normally in a company like ours is not the case. We would rather prefer to ready first 30-40 acres for phase 1 launch and simultaneously continue to add more lands as we go ahead. That's what we've been doing in practically every project that we are doing of this nature. So assuming 30 acres to be our phase, that phase gets consolidated or purchased first from the land standpoint, and then it goes into approvals, conversions, etc., which takes 6 to 8 months time in getting all the approvals. Post-launch, the process is not very long and the cash flow cycle is not very long. A 30 to 40 acres should get developed in 18 odd months time from launch, and that's how it gets delivered. And in that sense, cash flows ideally, if we sell 100%, should come 100% in 18 months from the launch date. So maybe 8 to 9 months of approval cycle and 18 and a half years time to launch and sell and get the cash flows in. That's the typical phase of a plotting scheme. And if phase 2, for that matter, starts in 6 months from the phase 1 of launch or whatever, then it gets dovetailed with the similar timelines thereafter. So this is a typical cash flow, launch, and kind of completion cycle for a typical plotting period. Of course, these are better days, good days, and hence sales cycle is shorter. We end up selling faster than what it used to be a few years back, and hence cash flow cycle is restricted to the development cycle, which is 18 months. Otherwise, it could be 3 months to 6 months here and there, and in any case, we should be able to wrap up some projects in 24 months, if not in 18 months.
And the second question is just trying to understand the HDFC platform. So suppose you have projects in HDFC platform which have been launched and those projects started generating net cash flow. So what happens to the net cash flow if in the projects of those HDFC platforms? Are they distributed among the shareholder or those net cash flows are flowed back into the projects or business development within the platform?
There is a pre-agreed waterfall mechanism in the agreements with any platform, including SDFC. So whenever cash starts pouring in, and obviously with the kind of velocities that we are talking about in a plotting scheme, cash flows are much faster than what we could spend having spent money on land already. On development, the cash flows, incremental cash flows are very small. So you end up having surpluses almost from day one of your launch. That's what has happened in 3 or 4 plotting projects that we would have launched in Ahmedabad and Bangalore both put together. And those cash flows then start going to the partners or the platforms in a pre-agreed based on a pre-agreed formula and waterfall mechanism. So they start getting repaid principal and interest simultaneously as we go ahead on the projects.
So both you, suppose there is a surplus cash flow of 100 crores from that project, and that project won't be needing money. So you will start distributing and as per the pre-agreed waterfall mechanism. And you will get some amount and they will get some amount, right?
Correct. So we'll keep paying and repaying immediately once the cash flow starts getting generated. And obviously that is repayment of the loan under that specific SPV for that specific project. The otherwise mother agreement, which is a platform, remains as it is, and we keep drawing money for the future next projects as we keep agreeing on new projects like we are doing right now. But I mean, from the point of view of repayments, yes, project-wise we keep repaying as project-specific cash flows are generated in the platform.
And is there any security like priority cash flow distribution to the SDFC or is there a kind of skewed distribution? I'm just trying to say, are they paid first and then you, or there is a skewed distribution? How is it done?
So that mechanism varies from platform to platform. For example, on priorities of cash, etc., platform 1 will be very differently configured as compared to platform 2. And as the risk-return ratio would be expected to move, in case we give more priority to the outsider or the partner, then obviously the ultimate returns are supposed to be lower. And if the priorities are similar and same and balanced in favor of both the partners, then comparative cost will be a little higher as compared to the first model. So this varies from platform to platform. And in this case, what happens in the current platform, if you were to talk specific, we also have a DM fee that we charge on top of the cash flow arrangement and the waterfall arrangement which comes thereafter. Of course, everything is broadly subject to cash being generated in the business. There is, these are kind of long-term patient capital in that sense. But before such distribution starts, we are allowed to take out our DM fees from the platform per se, assuming that to be a cost of managing the project per se for Arvind.
Sir, just one final question on this. So, sir, when do you think the distribution from this platform will start coming to Arvind Smartspaces? Because what I understand, most of them are horizontal projects. Whatever you have invested and launched, or to be launched, they would soon start generating positive cash flow. And so, by when do you think, and that will give you a watch list for further business development in the name of Arvind Smartspaces? So, just trying to understand, when do you think this money for the cash flows from this platform will come hitting Arvind Smartspaces?
So cash flows have already started coming in. I mean, Arvind gets quite a handsome cash flows already from these launch projects. Greatland, for example, apart from what we are paying to SDFC, there is significant money left for us to retain and invest and spend on various activities. So that's what is happening at this point in time. In fact, based on the formulas and based on the agreements, we would have loved to pay even more to SDFC, but then there is a formula defined. So we have enough and more money to be kept for us and to invest. So that's happening already. In the other project, for example, Fruits of Life, again, we've generated quite a bit of cash flow already. And in fact, those cash flows, instead of paying back to the platform, we've agreed that this will be straight away invested into some other project. And the project is already acquired. And in this case, I guess this is Dodballapur, right? So we've already invested surpluses which have come to the platform and Arvind otherwise into the next project from the platform point of view. So rather than repaying and taking money again, we just reinvested into the next SPV already.
Okay, sir. Thank you, sir. That's all from me.
Thank you.
Thank you. Our next question is from the line of Prem Khurana from Anand Rathi Shares. Please go ahead.
Yeah, thank you for taking my question, sir.
Sorry to interrupt. Mr. Prem, may we request you to use your handset, please? You're not audible.
Give me a second, please. Hello, is it better now?
Yes, sir. Please go ahead.
Yeah,
Thank
sure.
you.
So thank you for taking my question, sir. So just one question on the way we think about project addition or business development. So when I look at the quarter, we have done 3 transactions, 2 very large layouts wherein the execution cycle would run in 2 years, and you would also be required to kind of probably deal with a cycle or 2 as well. And at the same time, when I look at the transactions, fairly small. I mean, for generally, I mean, the threshold that we look at, I mean, in terms of absolute profitability, 116 crore with 10% share. So I understand the IRR would be infinite because you won't be required to put in any money. But then at the end of the day, you would have to commit some time from your management bandwidth to be able to manage that as well. So how do we think about when we are evaluating these projects, large layouts versus quick churn, wherein the IRRs would be extraordinary? Do we tend to have different sort of hurdle rates when we are evaluating large layouts versus smaller quick churn projects?
So it's a great question. I mean, one thing which we are very, very clear about, I mean, a couple of things that we are very, very clear about are, one, profitability. We don't want to be adding projects just for the sake of top line. It has to make sense to us in terms of returns on effort, and hence a project addition has to make some material difference to our bottom line, and that's one prime criteria that we keep doing, and that's what is reflected in our numbers consistently, where the margins are fairly healthy, and each and every project makes a lot of sense to us in terms of how much it earns vis-a-vis the size of business that we create. So that is one.
Sure.
The other is also the size of the project, even if in percentages it earns 25%, 30%, etc., but if the size is not great, and if again that goes down, the return on effort, as you very well pointed out, is not commensurate with the effort and the time that and the bandwidth that we are supposed to be using on a project at a location. Very, very pertinent. Now, while we have been doing this every single time, in this case the numbers look comparatively smaller, and they are looking, in fact, too small to start with. But the idea here is that DM is going to be a small component of our overall plan. This is just about second project out of maybe more than 25 projects that we would have taken up in the company where DM has been done. DM generally is low on absolutes, but then here, this phase of project that we have taken up in a larger township that is otherwise owned by the owner, this phase is small. But the idea is that if we can just test market it, and if we can set the proof right for this project for the landlords and for us, then there is a potential for this to become bigger and almost the same size as Forestier. Forestier, as you know, is a 5 lakh square yards of township. And we are not exactly clear on what is the development potential of this specific thing exactly, but of course it has to be much bigger than what this project looks like today. And if it makes sense to us and the landlords, then obviously the idea is to make this specific location and this specific project much bigger than what it is sounding today. So all in all, we are very conscious of this. We have been doing it like that, and this is how we are building the company. And this will be our prime criteria of taking any new project. And the mantra is to also ensure parallelly that return on effort is equally healthy as compared to the absolutes or the proportions and percentages that we look at while evaluating a project.
Sure. And so just, to continue on this, let's say if I ignore DM for the timing because not exactly comparable with the other two. We have one which is 500 acres and there's another 200 acres. So the timelines would be different in terms of execution cycle. So the guardrails or hurdle rates that you generally target, would these be different with these two projects? Because one is wherein you would have to spend more time, so which is where you need to do more work, in terms of assessing risk, and wherein there's the other one wherein it's 200 acres. The execution cycle on a relative basis would be smaller or shorter than the other one, the other 500-acre project. So, which is where the predictability could be somewhat better. So, when you're evaluating these two, would your guardrails or hurdle rates change with these two sort of projects, given the size and the time that it'll take you and the risk assessment that you need to do?
So here you're trying to compare 500 acres with 200 acres? That's the question?
Yes, sir.
Okay.
Yes, sir.
I think it's like it's like saying that if you direct a movie or if you are a director in cinema, how much time you will spend if you were to do a 1-hour movie or a 2-hour movie. I mean, at the end of the day, it's about the passion and the connectivity you have with what you do. And hence, to that extent, there is a threshold of effort which is required irrespective of whether it is making a little less financial sense or more financial sense. It's about screening in the first go whether or not you want to do a project, whether it is worthwhile doing or not. But thereafter, you can't be proportionate in the efforts and the attention that is required for a project. Every project requires time. Every project will require attention and energy and the passion. And that's what we do. Once the project is taken up, I think it goes through the same rigor of execution, design, controls, etc., as a big or a small project. So comparatively, yes, you are right, but that's a selection criteria. Once it is part of your family or one of the members in your larger family as a project, I think it deserves almost the same amount of attention that comparatively bigger would need. So in the short term, this is a constraint, but we would rather love to treat every single project with the same amount of rigor and vigor. Long-term projects are long-term, but then they get launched in phases. To that extent, the effort also gets kind of scattered throughout the longer lifespan of such projects, and hence it's not that disoriented effort required on larger projects on a per square foot basis, or a per crore basis of margin, etc., etc. So it is a natural hedge and a natural spread in that as well. But having said that, a project is a project and it needs attention in design, it needs attention in execution, etc., and that's what we do.
Sure. And so in terms of geographic spread, so I understand we're very large, I mean, as far as Ahmedabad is concerned, there's scope for us to kind of go deeper into Ahmedabad, even further. Bangalore also, I mean, we are already present and we are trying to kind of go deeper into that market. And MMR, we are still planning to kind of build the pipeline. And even Pune seems to be kind of where we've been focusing for a while now. But I mean, given the fact that we're planning to spend 1,000-odd crore rupees, and I'm assuming when you do PD, I mean, it'll be a combination of outrights, JDs, DMs. 1,000 seems to be a fairly large number to kind of invest and spend. Any markets other than these four that you would have evaluated in the recent past, and you would be willing to kind of go and try that market? I mean, for instance, I mean, we are one of the best when it comes to horizontal developments, and when I look at Gurgaon, at least for some time now, it seems that, I mean, there's demand for independent floors, plotted developments, and I mean, the way it's been with the NCR in the past, right? I mean, people there seems to be willing to accept or receive developers with proven track record. So would you be willing to kind of explore, let's say, markets like NCR, or for that matter, let's say Hyderabad, wherein people are willing to accept branded players with delivery track record and don't mind paying a little extra to have that delivery comfort?
Sure. I mean, again, a great question in that sense. It's basically a question about balancing between width and the depth, right?
Yeah.
There are opportunities all around us. One way to look at it is that all opportunities are right out there and we spread ourselves, but then are we spreading too thin? That is a question that one needs to answer. And the second answer and the second way to respond to this question is whether we are deep enough in the markets that we are operating or we are targeting at this point, which are these four markets, to be forced to look around and go beyond these. So the answer is that yes, if you were to at this point in time with 1,000 crore rupee kitty in our pocket, if you were to start looking around everywhere, we will be spreading ourselves too thin, and hence it's a red flag. The other way that I said is whether we have penetrated deep enough for us to feel saturated. The clear answer is no. Today we have some 6-7 active projects in Bangalore. I think we can easily double them. Having 12 to 15 projects active in Bangalore is not even that is not deep enough. You know the kind of numbers our competitors are doing there, and I think we have to target something like that. I mean, we still have to go a long way doing that. MMR is an ocean. We are not even a drop. In fact, we are not a drop because we have not yet started. Pune, we are equivalent to a drop in the ocean, and it has to expand. And Ahmedabad, by the way, is one of the one of the fastest growing, and the kind of triggers that we are seeing in Ahmedabad and the kind of investments which are flowing in, and some very, very specific things happening make us extremely bullish about the city in general, which is not only about the growth that this country in general is experiencing, but also specific Ahmedabad triggers are very, very strong. And if a couple of those triggers actually get materialized, then the growth and the opportunity here we see is extremely large. Again, we are not too big in Ahmedabad. Of course, we are one of the largest in terms of area being developed on a year-on-year basis. But I think there is still enough and more depth left in. By the way, we've not even almost touched the high-rise segment of Ahmedabad. Ahmedabad, we are known for horizontal, large townships, golf, very high-end villas, mid-price villas, etc., etc. We are just about scratching the surface of Ahmedabad, and still it is raking up some decent numbers for us. But I think significant scope to go deeper in Ahmedabad still left for us. So I think we'll, in the medium term, only focus on these four markets. As a general knowledge and understanding and the dynamics, etc., etc., we'll keep having a look at every single market, being in the industry. But medium term, I think we'll be very, very focused on these four markets.
Sure. Thank you very much for taking my questions, and all the very best for future. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one or two per participant. Should you have a follow-up question, we would request you to rejoin the queue. Our next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. So with respect to the launches for this year, are we looking to launch more than 2,000 crores worth of projects for FY24?
Are you asking this about the total top line projection of those specific projects which are under launches?
Yes, yes.
Yeah, for sure, yes. We should be launching 2,000 plus crores, yes.
And this should be totally our share, right? Like, this includes the one that we have acquired and also the Sarjapur, Dodlapur that we are going to launch.
So this, in JDs, we normally would have something like a 50 to 60% share and thereabouts. But the top line obviously is all ours. It all comes and sits into our books of account because we own more than 50%, etc., etc. So from the numbers and our books and balance sheet point of view, yeah, these will be the numbers coming into our books of account, 2,000 plus crores.
Okay. And with respect to the revenue recognition, my second question is about revenue recognition point. What revenue are we looking to recognize this year, or how much deliveries are we looking to do in this financial year?
Revenue recognition, I don't have the numbers to give guidance on. Maybe you could offline get in touch with Ankit, who is there in this call. Ankit is our CFO, as you know. Maybe if you can get in touch with him, and he will possibly go through the query and figure out what is shareable, etc. with you. But yeah, you can just get in touch with Ankit offline, and he should be able to help you to the extent he can on these numbers.
Okay. No problem. Thank you very much.
Thank you.
Thank you. Our next question is from the line of Naisar Parikh from Native Capital. Please go ahead.
Yeah, hi. Thanks for taking the question. The first one is, on the completed projects.
Mr. Parikh, may we request you to use your handset, please? Thank you, sir.
Yeah. Hello, yeah, sorry, is this better?
Yes, sir, thank you.
Yeah. So on the completed projects, can you give us a sense of, I want to get a sense of what are the margins on just the completed projects, how have, on the recent completed projects, and do we see that trend continuing for the projects that we're going to, launch and complete in the next 1 to 2 years?
Sure. So our margins generally at EBITDA level historically, I don't have the very specific exact numbers, but historically they are more like a 25% and thereabout range, the EBITDA margins. And current portfolio is broadly following the same trend. If you wanted to know specifics, project-wise, etc., I think they are there in the presentation. or we don't share that. So, I mean, Ankit, if you could just be specific on this.
So project-wise margin generally we do not share. But having said that, we have clarified that a typical plotting project has X type of margin, horizontal has Y type of margin versus a vertical. So with all the product mix which we have, currently we forecast that our margin should be 25% or more. That is what the guidance we have always been giving.
And historically that has been the trend. I mean, we are 25% and more on an average basis across projects which are completed or which are even currently under execution. From project to project there could be little variation here and there, but on an average we can broadly say that this is the kind of margin that we are kind of earning. And the criteria today of selecting projects is broadly the same.
Got it. My second question was, you spoke about the geographic expansion, but are you at any point in time considering to go, lower down the rung in the sense for tier 1 towns or something like that? Is that in the plan?
Not in the short term, not in the medium term. Absolutely focus on these 4 markets for the time being, at least in the short to medium term, and then to think about the rest of the things. Of course, then the tier 3, etc., will be following the rest of tier 1, tier 2 first. So, at this point, no.
Okay. Thank you so much.
Thank you.
Thank you. Our next question is from the line of Dhananjay Kumar Mishra from Sunidhi Securities. Please go ahead with your question, sir.
Yeah, hello, sir. So just one question. This 1,000 crore we are going to invest with HDFC. So how much money already invested, and from those, what kind of revenue potential is already created, and how much money you are going to invest more, and what kind of potential you see? I mean, that is overall you have got 5,000 crore revenue potential. So already, how much money already invested?
So we have confirmed and committed to a 300 crore project from the platform already, and the balance around 600 crores is yet to be done for the rest of the year. And in addition to that, some of our own investments will also flow, and that will add up to 1,000 odd crores. And you are right that in total we are looking at something like 4,000, 4,500, 5,000 crore rupee of top line. It greatly depends upon the product mix at the end of the day. What is more important for us is to make sure that if 1,000 crore generates 4,000 to 5,000 crores, and if that 5,000 crore gives you a 25% margin, then the margin that you earn from 1,000 crore is around 1,250 crores. So what is extremely important for us is to make sure that we earn an EBITDA of 1,200 crores and thereabouts. But the same money of 1,000 crore, if it is invested in plotting project, for example, it gives significantly less top line, maybe more like a 2,000, 2,500 crores. And if we invest this entire 1,000 crore rupee into a vertical project kind of segment, then 1,000 crore gives you almost like 6,000 crores. So on an average, at this point, the projects that we have taken so far under the platform are more horizontal in plotting, and hence top line might not be that great. But in fact, they might be outperforming on this 1,200 crore bottom line per se, or the EBITDA per se, because plotting is turning out to be a little better in terms of EBITDA margins for us. And hence, to that extent, we are fairly on track on our margins. Do we have specific numbers on the 300 crores that we did? What is the kind of, Ankit?
Yeah, so we have, out of the platform, we have committed 300 crores in Dodballapur and Fruits of Life project. And so far, the revenue potential for both these combined together is 800 crores.
And margin?
Margin project-wise,
we are not giving project-wise, but they'll be better than, they'll be more like a 1,250 and more on a 5,000 crore rupee top line. They'll be better than that.
And upcoming projects where we are maybe in advanced stage and which we may close in Q2, Q3 or Q4, so those will be on vertical lines or horizontal line only? So
I think we are wanting to create a fair amount of balance between the two, and going forward I think you will hear from us both kind of projects being announced, vertical and horizontal both. Horizontal of course remains a great focus area for us, but at the same time I think we'll be adding a few very exciting vertical projects as well.
Okay. And lastly, in terms of, as you said that cash flow from one project which will start immediately and that can be invested for new project. So in that sense, because our share is close to 330 crore, and this because of this reinvestment, overall balance sheet size will not stretch much. That is a fair understanding.
Stretching of balance sheet size in what sense you said?
Debt side. Our overall debt will not increase much even if we create this kind of pipeline, let's say 5,000, 6,000 crore in next 1 year. So our overall debt size, on our balance sheet will not increase much because of this reinvestment strategy.
Yeah, reinvest in fact will ease out the debt cycle, if at all. As such, we are negative today, but what happens when we reinvest, it means basically our money and their money comes back to us in the platform with margins and profitability, right? And that gets reinvested into the newer project. To that extent, it is debt-free in that sense, right? Platform money getting reinvested and our money with margins getting reinvested in the same proportion as we had. And to start with, the platform is not a debt product for us. And our own money with the margins is getting reinvested in the same platform. So it doesn't really add to the leveraging or debt levels, and hence it actually helps in that.
But the idea is not to keep the debt levels at a negative, and we will continue to leverage the balance sheet to optimize the returns overall.
Some reasonable level. Today it is negative, not a great idea. Of course, we have to catch up with the investment cycle and make sure that this surplus is getting invested at the fastest possible instance. That will happen. And at the same time, within very, very conservative and reasonable limits of leveraging, we'll be taking some bank funding so that there is an optimum level of capital and leverage and unleveraged going into the business and create value for every stakeholder.
Mm-hmm. But our net debt will never cross 500 crore mark. For at least next 2 years perspective.
At this time, it's not sounding like anything more than that. We have always said the same very statement that if at all, we will never cross more than 1:1 debt equity. And in practice, we have never actually crossed more than 0.7 or thereabouts. So I think even when we start leveraging, it should not be even close to 1. It should be less than 1, but 1 is a stated red flag for us.
Okay, thanks. That's all my side.
Thank you.
Thank you. We take our last question from the line of Shivam, who's an investor. Please go ahead.
Hello, sir. Can you just give us the guidance for FY24 pre-sale, what you are targeting?
As a matter of policy, we don't give guidance specific. But, just to repeat what I have been saying through various calls, we have been growing at a fairly consistent, healthy pace. And that growth rate in terms of top line, bottom line, EBITDA, fresh sales, etc., which are the most critical parameters to evaluate and understand the business and its trajectory. We've been growing at something like a 25% and a little more than 25-30%. So the idea is to continue with that momentum on a higher level and scale today. I think we are putting all the blocks in place to ensure that in terms of percentage growth, we maintain that. And we are putting all efforts and resources at this point to ensure that we do that.
And sir, are there any pricing trends increasing in Ahmedabad market? Are the prices increasing in the real estate market in Ahmedabad?
Prices generally have gone up. Prices generally have firmed up. In fact, there is a general trend of built-up property and land-based properties both appreciating more than 7 to 8% or more like 10% in certain cases that we would have seen in the last 1 year. And that trend is still quite active. So yeah, prices have gone up and they are still on a trajectory of going a little more up at this point in time.
Okay, thank you so much.
Thank you.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. As there are no further questions, I would like to hand the conference over to the management for closing comments.
Thanks. On behalf of the management, thank you everybody for participating in the earning calls of Arvind Smartspaces and for your continued support. I hope we have been able to address most of your queries. However, if we have missed out on any of your questions, kindly reach out to Vikram and he will connect with you offline on any pending questions or queries or suggestions. Look forward to interacting with you once again next quarter. Thank you very much for sparing time. Thank you.
Thank you. On behalf of Arvind Infrastructure Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.